In this video, I'm going to walk you through my step-by-step process to analyze the P&L of a franchise resale. Now, you don't need to have an MBA or be some financial guru to do this. I'm going to simplify the whole thing. So here we go. So here I have the P&L of a home healthcare franchise that I was looking at with a partner to buy. I'm going to break this thing down and we're going to go from there. The first thing I want to look at is the four big categories. We have income. So this is how much it did almost $4 million in personal home care services. Our cost of goods primarily is the caregiver wages, payroll taxes, and everything related to hiring the people who go to the homes and take care of the grandma. And then we have our gross profit, which is our sales minus our direct cost, which is the caregivers in this case. It did almost 1.4 million in revenue. It had about $615,000 of gross profit. It is often expressed as a percentage of sales to say it had a 44% gross margin, which is an important number. It's one of the biggest costs that we can control. And so that's why that's important. And then we have all these expenses. So I'm going to kind of walk through these, but you can see there's a whole list. And at the end of the day, he's showing an $8,200 loss. So we did $1.4 million in revenue and our P&L is showing an $8,200 loss. Now, the thing to keep in mind is, when you own a business, the more money you show down here, the more taxes you pay. Well, a lot of owners, including you, once you own a business, are incentivized to show zero profit or as minimum profit as possible, legally, of course, to reduce the taxes you have to pay. But as someone buying this business, there are a number of add backs that we want to do to figure out what the real valuation is. What is the real benefit to the owner? There's lots of different ways that they hide that. And then there's also decisions that people make that may not be the best decisions, but then you as the buyer can change, save money, put more in your pocket. So what I would do, the first thing I do is I take this column here and I copy and paste it. I rename this to add backs. And then I go through and start to identify, well, what are the things that when I take over as the new buyer are going to change? So the first one we have here is administrative wages. So these are the wages that you pay yourself. Let's say that we determined that I am going to take a salary of $100,000 a year instead of $125,000. That will help show a little bit more money on the bottom line. We can't really do anything about this, or this. We have a telephone here. Here we have another health insurance for the owners. Now in this case, you're still going to need health insurance, but this is a benefit that you are going to get. It's possible that, you're having health insurance through a spouse's plan or another plan that you're already on. So we're going to keep that one out of there. We have professional fees. We have accounting fees. Now, to be honest, $10,000 for accounting fees is pretty high. Let me say I talk to my accountant and he says, hey, I can do the whole thing for $3,500. So sometimes as you go through this process, you're going to talk to other professionals to figure out, are the numbers that they're paying reasonable or are they not? Credit card fees is one that we may look to cut later to improve our margins, but for the factor of determining valuation, I'm going to keep that in there. We have computer expenses, like all this stuff breaks, like you're going to have fees, insurance. Let's say you talk to an insurance broker and they say, hey, I can quote you at $8,000. Now you've got some here, right? So we have the cell phone, like, so he's got a cell phone bill and telephone bill, right? And so you find through discussing this with him that he says, hey, that's $6,800. That is the cell phone of me, my wife, my 4 kids, like everybody's on that plan. He wants to do an add back because you're not going to have that expense because you already have a cell phone. We put that back and then we kind of go through here. Now this is what it is. The rent, he has a good lease, you decide to keep it. Someone's going to come and clean the building, totally fine. And then he's got some vehicles and he says, hey, we're going to take these vehicles here, everything related to the vehicle, and those are going to be add backs as well because you already have a vehicle. Maybe not going to run it through the business. It's a benefit to you. We're going to have bad debt expense. He says, hey, you're not going to have that. All this marketing stuff and brand fund and royalties you're going to have. And then we got his financials. So we have interest, finance, loan, interest, all those as well. We are going to delete. So now we do some of the add backs. These are all totally reasonable. We say, hey, the real benefit, actually, we probably should add back your salary too, because you can choose how much money you take out of this thing or not. Comes to you, say, hey, this business is actually making $185,000 a year to you. That is what you are going to benefit. Now, if you take some of the salary, if you take some of that through paying cell phone bills and vehicle leases and all the stuff, that's up to you. But this is what the business is producing. And the seller would say, this is what I want a valuation to be determined based off. Good starting point. So now let's get into valuation. How much is this business worth? Well, a lot of small businesses like this one trade at a multiple of earnings. They could trade at 2.5 times, 3 times, maybe 3.5 times. That would be a stretch. And so what I would do is take that net operating income and multiply it by the number. So 2.5 times, let's just say it's worth 3 times. Let's say this one is 3.5 times. make these into money signs. So you could say this business is worth probably somewhere between $462,000 to $650,000, quite the range, right? So I know for a fact this business was bought for about $450,000. So we actually got a pretty good deal when you look at it about that way. We ended up buying it for 2.43 times, which is a pretty good multiple considering the reliance on the owner, the amount of cash flow, just the options that were at hand. That's what it's worth. So now I want to get into projecting out how much money we can make as we grow the sales. What I want to do is simplify this P&L. There are way too many lines on here and many of them are irrelevant. And so what we're going to do is we're going to take it and we're going to simplify it. And so we're going to look at sales. We're going to look at our cost of goods. We're going to look at our gross profit and our GP margin. Then we are going to break our expenses into two categories, variable and fixed. A variable expense is one that changes with the sales volume. So sales go up, this number goes up. If sales go down, this one goes down. And our fixed expenses, which stay the same. Our rent doesn't change whether we do 1 million, 2 million, or 4 million, the building is still the same. That is the first thing we're to look at is I'm going to go through and we're to categorize every one of these expenses as either variable expense or a fixed expense. Now, the easiest way to think about it is if I double the volume, would this expense double? And if it will, we are going to put a V by it. And if it's not, we are going to put an F by it right here. Administrative wages. In this business, we have caregivers who go to the homes and take care of people. We have people in the office who are scheduling and coordinating. I just happen to know that if I doubled the business, I would definitely need to double the amount of people in the office who help schedule and coordinate between everybody. Then we're going to look at the membership wages. These are wages I'm going to pay to myself. These are totally fixed. Our admin staff, who's temporary, would be variable. Our payroll fees, this is like what we pay to process payroll every week. If I double my volume, I double the number of caregivers, yeah, that number would probably go up. So that's variable. My telephone expense is fixed. My administrative mile, that's fixed. My health insurance, owner's benefit, professional fees, accounting, bank service charges, all fixed. Credit card fees are variable. If we double the amount of sales, we double the amount of money we swipe on credit cards, that number's got to go up. Office supplies, computers, software, caregiver supplies, postage, insurance, cell phone, internet. This is all fixed. Rent, janitorial, utilities, this vehicle that I'm not going to have, bad debt expense, marketing supplies, all fixed. The brand fund is variable. The brand fund in this franchise is a percentage of our sales. So the more sales we do, the more we're going to pay. Meals, travel, entertainment, all fixed. Our royalty is definitely a variable expense. If we double our sales, we're going to double the royalty. Interest, finance, loan, all that stuff's fixed. Our recruiting and retention. So if we hire double amount of people, yeah, like we are going to have to do more recruiting. We're going to do more background checks and we're going to spend more money on ads. So that is going to go up. And so they're the final ones. So then what we're going to do over here is doing a sum if. So we're going to take a sum if, which is this fancy formula in Excel, and we say, hey, what is the range we want to sum? So we want to sum all the numbers, and then it's going to say, what's the criteria you're going to look at? Basically, I want to say, hey, give me the sum of all the ones that have a V. And then what I want you to do, we're to like hard code these columns so it doesn't get messed up. And then what this is going to do is hard code the ones that are fixed. We're going to add these two numbers together. We're going to make everything look like money. And we want to make sure the 430,000 matches 430,000. If you have an error somewhere, like this is a Q or something, 422, it doesn't match, go find your error. Then we're just going to put in the sales volume. So the sales is here, the cost of goods is here, the gross profit. I would do this one by a formula is sales minus your cost of goods, and your gross profit divided by your sales is your gross margin, 44%, that lines up. And then we have our NOI, which is going to be our gross profit minus our expenses, $185,000. That should all match. The next thing I want to do is start to extrapolate what this looks like at different sales levels. So as I grow the sales, as I improve the margins, how much more money can I make? That's why we're in this business, right? The first thing I need to be careful of here is our variable expenses are going to rise as we grow the sales. So I want to make sure that we express this as a percentage of sales. So what I'm going to do here is I'm going to insert a column, and I'm just going to say variable. I'm going to take this as a percentage of sales. It's 22%. The first thing I'm going to dive into here is raising our prices. We learned that we are undercharging by 10%. That all of our competitors and everybody else is charging 10% more per hour than what we charge. And the owner just has not wanted to raise prices because he was kind of on his way out and he didn't want to rock the boat. And so the first thing we're going to look at is increasing our sales by 10%, which would give us to $1.5 million in revenue. Now our cost of goods is our caregiver expenses. Now, while he has not raised the prices, he has given his caregivers raises, right? Because he has to compete with other people who are charging more. So he gives more. So his cost of goods is actually actually going to stay the same, $775,000. So we are to raise our prices, but we're not going to pay our caregivers any more money because we already gave them raises in the past. When we copy down the rest of this formula, and there's going to be a few errors that I'm going to fix, our gross profit is going to increase significantly because we raised our prices. We didn't raise our cost of goods. So a lot of that is going to fall to the bottom line. Here's a little math we got to do. Our variable expenses, remember, these are the ones that are tied to sales. So if our sales go up, our variable expenses are going to go up. So we're going to take that $1.53 million and we're going to times it by the variable expenses. So our royalty or brand fund, we might have to hire some more admin wages people temporarily, whatever, is going to go up. Now our fixed expenses are going to stay the same. I'm just going to put them here. Or if you really want to be fancy, let's say they go up by 5%. I'm also going to change this formula. Once again, Excel magic here. If you put a money sign before the number, the row, that locks it in. And if you put a money sign before the first one, that's the column, that locks it in. That small change, raising your prices by 10% while not changing anything else, we increase our NOI by $100,000. We just made $100,000 to the bottom line, assuming we didn't lose too many customers by raising our prices. That's pretty darn good. And our margin went up to 49%. We had learned through due diligence that a bunch of other franchisees were right around the 50% mark. This made sense, right? We were undercharging. We got our prices to market. We're still paying caregivers the same because they're already there and our prices are good. But now we want to grow the sales. So let's start to look at some scenarios that say we grow the business to $2 million. So $2 million, though, we look at our formula, it kind of broke again, right? Because cost of goods didn't go up, but if we're taking care of more people now, this is going to have to go up. So part of this becomes a little Excel magic. I'm going to keep this at 49%. So if I keep this at 49%, I usually like to color code things if I'm doing something like this. Then I'm going to say the cost of goods is equal to this. So our cost of goods is going to be to 940 if our gross profit is 49%. Our variable expenses, you can always click on the formulas to see that the numbers move. We are good there. Our fixed expenses, once again, I have this little formula that just says, hey, just bump it up 5%. And so now growing our sales to $2 million increased our NOI to $440,000. We more than tripled the amount of money we're making out of this business as we start to grow it. And we're not done here. We learned that there's other franchisees doing $3 million, $4 million, $5 million out of pretty much the same size territory. What does this business look like as I grow? At $4 million of revenue, at 49% gross margin, assuming variable expenses don't change, none of these other factors changes, we got this business making $1 million. That's what's possible. This is what's exciting about owning a business is you can start with here, you have this opportunity, you can put in the hard work, you can have the resiliency, you can be creative, you can be driven, and you can really start to grow the business. And you can start to fine tune along the way. Like, I'm not even looking here, but as we go through, like, you may find, like, let's stop taking credit cards. Like, let's force everybody to do ACH and boom, I just made $15,000 more. We look at software, we look at dues and subscriptions, we look at the rent that we're paying and the type of spaces that we're in. Like, when you own a business, you can go through this model. I bet there's $20,000 or more that you could pick up in your bottom line today if you wanted to. The final step here is looking at the actual cash flow. And so let's say we purchased this business for $450,000 and we went to the bank and we said to the bank, we are going to put down 25% of the purchase price. So we put $112,000 down, which means our loan is going to be $337,000. The term is going to be 10 years. Our rate right now is, let's say, 11%, and our payment. So in Excel, if you go PMT and then hit tab, it opens it up. The first thing it wants to know is a rate. And so if you do the rate, you have to divide by 12 if we're going to express this in number of months. And then the number of periods is years, but then you need to multiply that by 12 to get the number of months. So we stay consistent with our monthly payment. And then you're going to put a comma and you negative whatever your loan amount is. And then I always close it off there. So here our loan payment is $4,600 per month. And then you could just go down here and you could say annual. And so our annual payment is $55,000 a year. And so if we were going to look at our actual cash flow, we would look at our debt service down here at $55,000 and our cash flow at $129,000. Now, obviously, as the sales grow, your debt payment stays the same, which puts more money to the bottom line. That's all I got for this video. I hope you got a lot out of it. I hope you enjoyed it. If you want to learn more about franchising, I have a newsletter I write every single week. I dive into how to find them, how to operate them, how to scale them, how to sell them, all this stuff. I hope you got value out of this video, and I'll see you in the next one. Cheers.